Hey everyone, and welcome to The Explainer. If you are on a mission to build a portfolio that pays you consistently, well, you're absolutely in the right place. Okay, let's dive into this. Today, we're tackling a massive topic for anyone who wants their money to actually work for them, and that's generating regular, reliable income. Specifically, we're going to break down the ultimate battle between two heavyweights in the investing world, REITs and debt funds.
So that brings us to the golden question, right? Which one should you actually choose? It's a super common dilemma. You worked hard for your money, you've saved up some capital, and now you want to flip that switch from simply saving to actually earning a passive regular income. You've likely heard about the rock-solid stability of debt options, and you've probably also heard about how lucrative real estate can be. But which one is the right choice for your specific situation?
To answer that, here is our roadmap for today's explainer. We'll start with a quest for regular income, then understand the basic differences, put them head to head, weigh the pros and cons, and finally, we'll reveal the ultimate combination strategy. Let's get right to it.
Part 1. The quest for regular income. To make a really informed decision, we first have to understand the fundamental mechanics of how these two assets actually generate cash. First up, we have the REIT, which stands for Real Estate Investment Trust. Basically, a REIT generates its income primarily from real estate rent. Think of a REIT as a company that owns, operates, or finances income-producing real estate. When you invest, you're buying a piece of a massive real estate portfolio. Just imagine owning a tiny slice of a sprawling tech park in Bangalore or a really bustling shopping center in Mumbai. The regular income you receive is quite literally your share of the rent collected from those physical tenants. Pretty cool, right?
Now, on the flip side, we have debt funds, and the mechanic here is completely different. Instead of collecting rent, a debt fund generates its income primarily from the interest paid on bonds. When you invest in a debt fund, your money is essentially being lent out, maybe to massive corporations or even the government. And in exchange for your money, they agree to pay regular interest. That interest flows straight back to you as your income. So, to keep it simple, we've got rent on one side and bond interest on the other.
Moving on to Section 2, understanding the basic differences. Let's look at how these mechanics play out in the real world, specifically within the Indian context. You've got major listed REITs like Embassy Office Parks, Mindspace Business Parks, and Brookfield India Real Estate Trust. When you look at these real-world examples, they typically provide an income yield of somewhere around 6 to 8%. But here is the absolutely crucial takeaway. Your total return is that 6 to 8% income yield plus whatever price movement happens with the REIT's share price on the stock market. So you're getting partly predictable income and partly market-driven growth. It's a mix. All right, Section 3, REIT versus debt. Head-to-head, let's see how this builds when we put these two financial instruments into a direct side-by-side battle. This is really the heart of our explainer today. Notice the clear trade-offs across these different features. For expected returns, REITs offer a variable 7 to 10%, while debt funds offer a much more stable 6 to 8%. Now, with that higher return potential in REITs comes moderate volatility, whereas debt funds boast very low volatility. Both give you high liquidity, meaning you can pull your money out relatively easily if you need to. But check out the risk types. REITs expose you to broader market and real estate risks, while debt funds expose you to interest rate and credit risks. Ultimately, if pure, unshakable income stability is your only goal, debt funds score high, while REITs score moderate. Section 4. Weighing the pros and cons. Because, as that data makes pretty clear, there is no such thing as a perfect, risk-free investment. Let's start with the bright side of REITs. The advantages here are really compelling. You get that regular rental income, obviously, but you also gain exposure to the massive real estate market without having to actually buy a whole building or, deal with leaky faucets at 2 a.m. Plus, you get the potential for capital appreciation, meaning if the properties go up in value, your investment does too. Finally, it provides a fantastic diversification benefit to a standard stock and bond portfolio. However, we gotta stay grounded here. Because REITs are traded on the stock market, they are definitely subject to market fluctuations. More importantly, rental income isn't guaranteed. It depends heavily on building occupancy. I mean, if there's an economic slowdown and companies suddenly downsize their office space to work from home, REIT revenues are going to take a direct hit. They're also sensitive to changing interest rates, which can impact both property valuations and borrowing costs. Now, let's shift our focus over to debt funds. If the REIT was all about growth and opportunity, the debt fund is about a conservative, highly predictable vibe. You're looking at stable returns with much, much lower volatility. Because you're dealing with fixed interest payments, the predictability is simply better. This makes debt funds absolutely perfect if your investment horizon is strictly short to medium term and you just cannot afford massive swings in your portfolio's value. But, of course, that stability comes at a cost. Primarily, you're going to face a lower return potential compared to REITs. There's really limited growth because your capital generally isn't appreciating, you're just collecting the interest. You also face interest rate risk. Simply put, if new bonds start offering higher interest rates, the older bonds inside your fund become slightly less valuable. And then there's credit risk, which is the small chance that the borrowing entity might default on its payments. Section 5. The ultimate combination strategy. We've defined them, compared them, and weighed their pros and cons. But having the data is only half the battle. Applying it is what makes you a smart investor. And this brilliantly illustrates how we apply this stuff. It's all about matching the asset to your unique profile. Take Investor A. Their primary goal is stable income above all else. They absolutely despise surprises. For them, choosing the debt fund is 100% the right move for smooth, reliable returns. Then look at Investor B. They want regular income, sure, but they desperately want growth too, and they're willing to stomach some market fluctuation to get it. For Investor B, the REIT is the clear winner. So let's summarize this decision-making process. You really need to ask yourself which camp you fall into. Choose the REIT if you want higher income potential, you're comfortable with moderate volatility, and you actively want exposure to the real estate market. On the other hand, choose the debt fund if you prioritize pure stability, you're highly risk-averse, and your financial plan relies entirely on strictly predictable returns. But here is the real aha moment of our explainer today. Who says you have to pick just one? The truly smart approach is actually a combination. You use debt funds to build the bedrock of stability in your portfolio, and you layer in REITs to provide an injection of higher income potential and valuable diversification. By mixing both, you get to custom tailor the exact blend of safety and growth that fits your life. I want to leave you with this core summarizing thought. Debt funds give stability. REITs give income plus opportunity. Smart investing isn't about finding a single magic asset. It's about deeply understanding your tools. So, I'll leave you with this question to chew on. Are you leaving money on the table by playing it way too safe? Or are you taking on unnecessary risk by blindly chasing high yields? It's all about finding your balance. Just before we wrap up, please note that this conversation is for educational purposes only. Mutual fund investments are subject to market risks, and you should always consult a qualified professional before investing. Thank you so much for joining me on this explainer, and happy investing. Catch you next time.